just in time for your weekly, most comprehensive look at the world of business and economics. Welcome to Business Redefined. We are focusing on taxes. We've covered this before, but we can't have enough of this conversation because of the feedback we received. And we are privileged to have the Commissioner for Domestic Taxes, Rispah Simiyu. Welcome on set.
Thank you, Julian.
Glad to have you. Let's kick off by a look at the numbers which were gazetted last week by the National Treasury. I was pleasantly surprised by the performance registered. Given what I had seen in Q1, it looks like Q2 was particularly strong. Is that the case?
Yes, it is. And I would like to take you back a bit even before you come to Q1 and Q2. Looking back in the last fiscal year, Q3 and Q4, that beginning January to March and April to June of 2020. April to June was worse than, it took a dip compared to January to March. And obviously because of the impact and the effect of the COVID-19 pandemic. As we went into this current fiscal year in the half one, so our Q1 started picking up, not to where we intended it to be. And of course, Q2, what we are seeing is a more solid performance. And for us, from where we placed, we are looking even into a better half two. So yes, that is it, indeed in the factors they are. Economy is doing much better. KRA is responding accordingly. Compliance levels are going up. So yes, we look forward to actually a very strong half two.
Clearly, we have new taxes. Let's start with minimum tax, which seems to be the elephant in the room in every conversation that I have. The exemptions which have been extended to oil market companies, for example, a bit of insurance companies. Oil market companies triggered my interest because they deal in both products which are price regulated, that's super petrol, etc., and then they deal in the non-price regulated products like lubricants. When you are focusing on the implementation and compliance of minimum tax, how do you then disaggregate these two?
The whole idea behind that exemption was to look at entities whose prices are controlled by government. What that then means is that you really have very little room to wiggle as far as your top line is concerned, your turnover. So, and specifically to your query, yes, we would also look at the products that you're offering. Where is a bigger bulk? Where is a bigger percentage? But having said that, this is a new tax. We had to start somewhere, late as we were in the field. And as we're doing that, we are monitoring it on the go. So we are refining it as we go. We had to start somewhere, we have to implement it. And as we go, tax laws tend to be dynamic. And I mean, the tax laws, as they change, they need to be dynamic to respond to the dynamic economy. So as we're doing that, we'll refine it as we go. Probably not just the oil marketing companies, others might come, they might fall off. So it will depend on how we monitor it and how we see it going.
If we were to look at this from the premise that if your price is regulated, then you warrant this consideration, banks will throw the same argument, and here's why. As we speak, for example, they've all written to the central bank seeking clarity on pricing, because ever since the rate cap, there hasn't been much. They haven't received response. So effectively, they are all almost capped. Then would they be eligible for this consideration is the question.
I wouldn't wish to say a blanket yes or no. And I think that goes back to the earlier point that I'd said. The general rule, there's a general rule and there are exceptions. So yes, very little room to wiggle as far as turnover is concerned. And certain considerations go in. And one of them is what you pointed out. Generally, you'd have your targets, or rather the price is targeted. But is that, capped? But does that apply to all your products? So we'll be looking at case by case as we go along, fine-tuning, onboarding others, and dropping others from the list.
You mentioned that, we're not the only ones with minimum tax in our jurisdiction. That's a very important point you've raised, and why that is the case is because if we look at peers, for example, I know that Nigeria, for example, last year in Q4, they had to revise theirs downwards because of the realities. If you look at Tanzania, they are not at 1%. The question has been asked, should we have a conversation, not whether we should have minimum tax or not, but whether we should revise downwards the rate? What are your thoughts on that?
My thoughts on that is that every entity, every jurisdiction, looks at its specific case. Case in point, you've actually mentioned Nigeria started with a higher figure. Then depending on the market reaction and the response from the market, then they reduced it accordingly. And take an example also of, not minimum tax necessarily, but withholding VAT. If you do remember, we started with 6%. But because of the feedback from the market, the reaction, the increase in VAT refunds, the other repercussions that came with it, we saw the need to reduce it to 2%. It is the same case with every other tax. And remember, giving them credit, giving Kenya credit, like I said earlier, we have to start somewhere. Nigeria, Tanzania started somewhere. And depending on the response from the market, the reaction from the market, the specifics. You see, when you roll out something, you start with a general law. As I said, it might not apply to everybody, or it might impact others differently than others, affect others negatively than others. So depending on the case by case, there might be a need to reduce. You'll be surprised, there might be a need to increase.
There is a concern widespread that it could yield a perverse outcome. Perverse in the sense that we are now targeting as much as loss-making companies. Then I sit and ask myself as a business operator, I'm in losses. Now I have to pay on my turnover. Why not just shut this business after all? I mean, because either way, I'm incurring now this tax burden which I didn't have before. Does this bother you?
It does, and it's a fair comment. But then again, it is also from a fairness perspective and looking at the tenets, basic tenets of tax, fairness, equity. Then you ask yourself, you've been in business for 5, 10 years. You're consistently reporting losses. Are we missing something? Should that be the case? Shouldn't you have changed your business model? Should you have changed, maybe ventured into other products? So even for us as KRA and the government generally would be left asking the same way. You'd be saying, why am I paying taxes when my bottom line is in negative? And we'd ask ourselves, why are you in business consistently 10 years when you're making losses?
Interesting take. How much do you target to raise from minimum tax, particularly in this 6 months period now to the end of the financial year?
Minimum tax, we are hopeful to have an upward of about 4.7 billion, in that range of 4.7 billion.
When I look at the taxation environment in Kenya, because having covered it for a bit of a while, it bothers me that we keep on changing every other financial year. So we think that manufacturers should get an electricity rebate. We give them 1 year, financial year later, we're out with it. The question is, do we have a coherent tax policy which actually guides this country? If I'm an investor looking into Kenya, that unpredictability becomes a risk.
Tax laws seek to serve various things. Now, the obvious and the default from you and probably everybody else looking at tax is that the intention is revenue mobilization, revenue collection. But then there are other things that tax laws seek to serve, and in the space of fiscal interventions. So you're looking at investment incentives, income redistribution, managing consumer habits, discouraging the consumption of harmful products, etc., etc. Now, in looking at all this, then what is expected is tax laws that are dynamic, that respond to the times. Now, specific example, go back to April 2020. Something thrown in our face that we didn't see coming, COVID-19. What did the government have to do? Quickly do something that then will cushion you and me. At an individual level, at a corporate level, everybody was cushioned. So VAT reducing from 16 to 14, the taxes reducing from 30 to 25. What am I saying is that whereas the tax laws are responding also, they're expected to respond as it is. Yes, I do take your point, and I agree with you that a national tax policy is important for the environment to be predictive. To that end, there's something in the works, something that we're working on a policy framework that will make it predictable. And as you will agree with me, a framework is supposed to give the general guideline. But that does not take away the fact that even tax laws need to be responsive to the times.
When you came to office in October 2020, one of the sentiments I got is that she did a stellar job in the ADR department. Let's see what her strategy is as far as widening the tax base, which is the headache in this economy, is concerned. What are your strategies? I'm
looking at various things, and maybe you'd ask then, what do I want? Where do I want my impact to be felt? One, we do know that even looking at the tax base expansion, the default perhaps and the cry, hue and cry has been, why do you keep going for the brick and mortar? And that is the reason why we are expanding that, and we know in this economy there's quite a number of people doing different business on different platforms. And case in point, like even the DST, the digital service. So there are a number of people carrying out business in different platforms, not just the usual brick and mortar where you'd find them every other day. There are people carrying out business, a lot of business in the informal sector. So we are looking to bringing these people into the bracket through various ways, literally visiting our people, sensitizing our stakeholders, and with an aim of also educating people, sensitizing people about tax.
Right, and that point by Madam Rispah Simiyu takes us to a short break. Business Redefined will be back with a lot more on this conversation on the tax environment. Welcome back to Business Redefined, your weekly most comprehensive look at the world of business and economics. We are focusing on the tax environment, and we are privileged to have Madam Rispah Simiyu. Welcome back on set.
Thank you, Julian.
Glad to have you. The digital services tax has started a lot of discussion online, and I think one critical question is the subject of influencers. And why that is the case is because a number of them already are subject to withholding tax, depending on what they're offering. Don't you think then it is two taxes on the same income, and that should be a matter of concern?
Digital service tax, all it's doing is trying to bring everybody else outside the normal framework as it is into the tax bracket. Now, the 1.5 is on what you make. So as an influencer, you've provided a service. That's why it's digital service tax. Very important to clarify, because some people have asked, if I sell goods online, should I be taxed? So it's important for me to clarify that it's DST. Please make S capital, service. So as you're providing a service, you are paid for it, then you come into the bracket. So if you provide a service, some people will just probably want to be on YouTube, want to be on various platforms for whatever reason, but you're not being paid for it. It means you're not earning an income. Now, going back to the basics of taxation, our Act looks for tax when it is incurred or accrued in Kenya. So on the DST, when it's generated or accrued in Kenya. So you're earning an income in Kenya, whether through brick and mortar, established business, or whether you're doing it through the digital space. So as an influencer, you get paid. So two ways of looking at it. One, as a resident, or if you have what we call a permanent establishment, you could be a foreigner, but with a permanent establishment, you have presence in Kenya, then you look at it as an advanced tax, because at the end of it all, you'll be preparing your financial statements, computing the tax payable, and then taking a credit for whatever taxes you have already paid. What that means, that credit is actually cushioning you to ensure that you pay that what is due from you and not a penny more. Now, when you look at our non-residents, so they are non-resident for tax purposes, they don't have a permanent establishment here, then for them it is a final tax. So for them, whatever it is they get using an online platform and the income is generated or accrued in Kenya, then they pay on what they earn.
Here's a case in point, just latching on to what you've said. There are instances where a number of local persons are engaged by non-resident entities, and the non-resident will have already baked in the cost being incurred and transferred it to you as the service provider. Now you are local, and then you end up being not very clear on how you should then deal with the DST, given that already someone else seems to have factored in but is pushing it onto you. Are you bothered that that then could create a gray area as far as this implementation is concerned?
I would say DST and the scenario that you've painted is really not unique. We've had instances where, even with a brick and mortar space, but so any business, when you're interacting or dealing with a non-resident, every jurisdiction, and not just Kenya, Kenya is not unique in this space, is that when a foreigner or a non-resident for that matter, no, let me not call it foreigner, so when a non-resident is transacting in Kenya, when they're getting into that contract, we've seen many instances where they build in the tax in their figure, so that knowing very well that every country has different rates. And the whole idea is that by the time they receive their money, they're receiving it net. Okay? So, in other words, there are some who would go to the specifics. So if they know that withholding tax, for argument's sake, is 20%, in the absence of a DTA, double tax agreement. So if, for argument's sake, we say 20%, what they would do, if the cost of their service is 100, they'll build in the 20. It is the same way it would work in this case, because for them, remember, if they are the ones billing, it means they are the ones earning or accruing revenue from the country. So you're just withholding from their portion, that which they should get. So remember I said earlier that with non-residents, it is a final tax. So it is what they are accruing from Kenya. So that is what you withhold from their portion. Now, in your case, as a resident or someone with a permanent establishment, all this will be factored in as an advance tax, so that at the end of it all, you're brought back to the place where you'd ordinarily have been, whether you transacted as in DST or in any other.
One of the concerns, correct me if I'm wrong, I have around DST is really a visibility of the transactions. And why that is the case is because a lot of our transactions nowadays happen in the mobile money space. And to the extent that you're working with aggregators, I don't know whether it's mobile telcos or banks, because the payments go through somewhere either way. How do you know, how do you distinguish a mobile money transaction, for instance, that this is not just a usual P2P remittance, this is actually a payment for this service, in the event that we don't have the very formal structure where then I have a KRA PIN and I'm compliant with this, because many, let's be honest, many don't have that.
True, we've actually worked with all these, and I would call them our key stakeholders as far as DST is concerned. Because when you look at a bank, the bank will have its different codes, different approaches, aggregators, the same thing. So we are really also banking on them and as our key stakeholders to work with us to be able to differentiate, because we don't have their systems, we're not in their systems. But going forward, at some point, we look forward to a point where we'll have integration, systems to be integrated so that you're able to pick it quickly, it is efficient. In the first instance, you're able to tell the difference, what is taxable, what is not taxable, but that is work in progress. But we'll get there at some point.
COVID-19 threw a curveball, and one of the relief measures was a conversation around VAT refunds. How do we stand on that front?
I would say from a VAT refunds perspective, we're doing exceptionally well. Government has done a lot in this space to cushion businesses from the adverse effects of the COVID-19 pandemic. Specifically looking back last year, sometime around May 2020, government released about 10 billion towards this VAT refunds. And by June, this whole amount was paid out. Because pre-receipt of the money, we would have done various audits to validate, to verify the claims, because it's not just receive and pay, or you claim and we pay. We have to validate the numbers. So that had been done. We do know that there are certain industries that had been impacted more adversely than others, and looking at the flower sector, the aviation sector, and we did fast track the payout. So that went out. So as of June, full amount paid out. Looking at the full year to June 2020, KRA actually recorded the highest payout, basically KRA history, to the tune of upward of 25.5 billion. Now, coming into this year, this fiscal year, beginning July 2020 to going into June 2021, government has been giving consistent amount of about 1.2 billion per month. This has been up to 1.7 B. At the end of December 2020, already 10 billion had been paid out. And over and above that, government has also allocated an amount towards the economic stimulus package, an amount of 5 billion, again towards the VAT refunds, and already KRA has received 2.5 billion, so 50%. So looking at these numbers, I would say in that space, government has done and is doing quite a lot to ensure that businesses are cushioned, we get this money back into the economy so that it can generate even more income and more, revenue for us to collect.
Okay. Recently, we saw a notice issued by the Revenue Authority regarding corporation tax and guidance as to how compliance should be done in light of the reversion of the COVID-19 relief measures. A lot of concern, and understandable, that it complicates compliance, because depending on when your year end is, you could essentially be playing with two tax rates. Correct. From a compliance perspective. Correct. Don't you think this concern is valid?
Julians, I would say yes, the concern is valid, but not as far as the public notice is concerned. If anything, that public notice, the intention was to clarify what should be done. The ideal situation, the idea here was that if your revenue or whatever you generated fell between that period where there was a peak, and especially looking at the effective date of April to December, then case in point of the 25%, then that income should be taxed at 25%. And yes, you make a good point that the year ends a straddle between the years. So that is why when the Tax Laws Amendment Act came out, it brought out a clarification that anything from January 2021, any income you generate from that point, then will be taxed at 30%. So the idea here is to look at how do we, if your income straddles those 2 years, generally you should be looking at year of income. And the year of income ideally should be, where does your year end fall? And as a result, what was the rate at that point for which then we should apply on the income for the preceding 12 months? But in this case, you'd find that an entity probably start of the year is April, meaning it will run up to March this year. So it has straddled 2 rates. What are we doing in that regard? One, through the public notice, clarify how do you account for the two windows. Then secondly, that's the reason why we have this concept of relationship managers. When you're not clear, reach out to us. We are there to support, to assist. And then thirdly, we are also enhancing our system to make it easy. I know sometimes maybe the reaction, turnaround time might be slow, but that we've taken into consideration. And if you noticed, even the public notice where it said that in the event that this leads to penalties that were unwarranted, once validated, then that will be addressed administratively. So we are alive to that fact that we had as KRA, ours was reactive because there is that pandemic that has thrown a spanner in the works. Laws have changed for a good reason, to cushion you and me and the businesses. And thirdly, our system has to be very responsive. And that comes back also to the earlier point saying how even the tax laws need to be dynamic. So you have the framework, but also have something dynamic that quickly responds to what we are seeing on the ground. So in summary, it wasn't supposed to cause confusion. It was supposed to bring clarity. And we are here to clarify.
Given what you've said, let's take a scenario. I'm a company. I was already compliant before the notice was issued, and I filed with the rate which was not appropriate. What then happens?
So it depends. If it is a case where I take it that you filed within timelines. So if you notice in the public notice, we said, say, for example, you filed with 25%. You made your computation based on 25%. But the law, from the clarification, the law, like the straddling, January onwards, should have been 30. Then it means ideally you've paid less. So that then will attract a penalty. So if the system had not been enhanced to allow you to do that, yet your intention is to comply, and based on the scenario that you've painted, the intention was to comply, that's why you file the return. That statement was very clear down there. In the event that we see that there are penalties that should not have been attracted, then we will address it once validated.
The voluntary tax disclosure program, there is a general consensus among tax pundits that the one we had in 2004 was like the most successful. And the key question I get is, what lessons are we drawing from that experience to this experience, to what we're now trying to roll out, already rolling out actually? And then how much do you think you can mobilize through this exercise?
We can mobilize quite a bit in this exercise, probably not specific back of the envelope as of now. But what are the lessons learned? It's more about reaching out to our taxpayers and being alive to the fact that not everyone is out there to evade tax. There are people whose intention, and it's very noble, to be compliant. But then it does happen for whatever reason. You'd have missed something out. And to show you that you should not fear, we have opened up our window for you to actually reach out. We engage, and as you've seen, we've bucketed it. That the sooner you come to us, the higher your chances of 100%. So what we are doing is also to encourage compliance, because the same way you're encouraging compliance, we are showing you, we are giving you a window where as long as you voluntarily disclose and you do a full disclosure, then there is no plan to come back to you to audit. Now, there are instances where, and I think as you saw the law says that where we've given you a notice of intention to audit or carry out a compliance check, or you're being investigated for whatever reason based on, tangible information that we have, or you're already engaging litigation, it means your case has already advanced. This is a leaf, I would say, being dished out to those who willing tax compliance, you've not tax compliant companies or entities, you've not gone into that process already, and you're willing to say, I want to clean my books, and here I am. So this is just a special program for now, not to say that that concept of voluntary disclosure does not exist. It does exist. It's just that at that point, penalties and interest go through a separate process that is dictated in law. But this one, because it's a special program that covers years from July 2015, 5 years from July 2015, so to June 2020, but then the disclosure is happening from 1st of January 2021 for 3 years. It's just a special program to close in on that gap. But then that other window, the general one, still applies. So for us, it's just telling taxpayers, we are alive to the fact that mistakes are made. Yeah? Not deliberately, but they happen. This is your window to clean your books.
And that point by Madam Rispah Simiyu takes us to the close of our conversation on Business Redefined, where we've been focusing on the tax environment in Kenya. Up next is the Markets Report.